We're very proud to present the founding and managing partner of URS Capital Partners, Christopher Urso. So welcome, Christopher, to our podcast.
Thanks so much, Bill. Appreciate the opportunity to be here.
Excellent. Well, you've built something really impressive here, scaling from single-family renovations during the '08 downturn, to a $600 million multifamily portfolio today. Amazing. And you've seen multiple market cycles, navigated tough environments, and yet still delivered strong returns. So, this is an honor here. Let's start at the beginning, if we could. What set you on this path? What was your light bulb moment when you decided to get into this niche in real estate?
Sure, I appreciate it. Definitely have seen a lot over the years. It actually dates back to 2000. So I graduated college in 2000. My wife and I both, at the time, my girlfriend graduated same year. I went to Manhattan College. She went to Fordham, and we were both working in the city. She was at the New York Fed. I was at a company a buddy of mine from college had owned, non-real estate related, but a friend of mine had handed me a book, Rich Dad, Poor Dad. I'm sure everybody's heard of it over the years, and read the book about 10 times in a matter of a month, going to and from Manhattan on the train, and really gave it to Lisa, my wife, and told her to read it. And we both really gravitated towards real estate.
Nice.
The concept of investing in real estate. Neither one of us had come from a family that was in real estate. But we were both kind of entrepreneurial by nature through college and, starting small businesses, working at a buddy of mine's business, and gravitated towards real estate and started to talk to some friends if they knew anybody that was doing it. And we were fortunate enough, we were introduced to a gentleman in New Jersey that was buying foreclosures, basically 2 to 4 family foreclosures in Paterson, New Jersey. And we went out there on the weekends, young kids at 21 years old, after going out on Friday nights, in the city, and we'd wake up early with a hangover most weekends, and then drive out to New Jersey and kind of shadow him. And after doing that for about 6 months, he came to us and said, "Hey, we have a 2-family. We just finished renovating. We'll help you out, get it set up with tenants, and we can help you out any which way you want. It's about $250,000. You want to buy it? You need about $25,000 to put down on it." And I said, "Yeah, I definitely want to do it." Lisa, smarter than me, kind of did the numbers, looked at it. We could be cash flow positive about $800 a month. And I didn't have 2 nickels, let alone $25,000 to put down on it. But my parents, for graduation, my gift was going to be to pay off my student loan, which was about $24,000. So I sat down with them. They had worked really hard to make sure I came out of school with no debt, and had to convince them to give me the money to go put down on this 2-family, and then I would make the loan payment of $179 a month on the student loan. And they were super nervous. What if the tenant, slips and falls? What if the place goes on fire? All the what ifs. My parents didn't come from this world. And I looked at them and said, "Listen, what if I get hit by a bus tomorrow? I want to do this. I want to take this chance." And we got told no by lenders, by attorneys. We couldn't do it the way we wanted to, and we muscled our way through, and we got that first deal done. And that's where we kind of learned the ins and outs of the benefits of investing in rental property, and went on to do a handful of deals between 2000 and 2007. While we were working, Lisa ended up going to get her master's in real estate, became an investment sales broker in New Jersey, selling rental investment property. And we had done a couple of small deals, raising money from some friends along the way. And 2007 came, and things just didn't feel right. We sold whatever we had. And the company I was with also sold, and I had a little sliver of equity there. So we had a little nest egg of, call it $300,000-$400,000 that we've accumulated, and decided we were going to go into real estate full time. At least I was. And then 6 months later, the world imploded.
Wow.
And I'm 25, 26 years old maybe. And had to figure things out quickly. Being in New York, I couldn't really do anything here with a couple $100,000. And, I had to start to look
the center of the storm.
Wow. Yeah. And no financing for a young guy that, is a young budding entrepreneur that wants to take over the real estate world. So I had to find markets outside of New York that we can get into that had a lower entry point, give us the ability to get moving. And I, did a bunch of research, landed in Cincinnati, Ohio, and liked that there was a lot of Fortune 500 companies there. It was kind of steady Eddie Midwest market, lower entry point. So we put together a team, a contractor, a realtor, a management team, and we started buying distressed, foreclosures. Basically, all I knew was 1 to 4 family residential. So
Yeah.
just got moving, buying homes for $10,000, $20,000, putting 20 in, renting them out for 800. After a year of doing that, my goal was to get to $100 million of real estate. And I was doing the math and saying to myself, I'd have to do like 1,500 transactions at this pace to do that. And had a coach at the time, and he said, hey, why don't you look at multifamily? Instead of you having to go buy 20 or 30 duplexes, go buy a 40 or 50 unit building in one place. It's much more efficient, and you can kind of take the same concept and scale. So switch gears.
Sorry, I just got to jump in. Is that when you launched URS Capital Partners around that 2008 financial crisis?
Yeah.
Most people were running the other direction during this time, and yet you ran towards it. What did you see that others did not?
Probably a little bit of naivety and, to go along with it. That helped me. But, I'll never... I'm so grateful that I started when I started. I think there was a lot of fear and uncertainty and, unknown that we had to navigate. At the time, I didn't probably understand it enough. I wish I knew then what I know now. But long and short, we bought our first vacant 40-unit building in December of 2009. We raised the money from friends and family. And then from there, we went on. I think that was all in $450,000 at the time. And we did a couple of small deals in and around Cincinnati, 23 units, 37 units. And then I started to look at markets down south that I felt had a bigger runway ahead of them. And, focused on Charleston, South Carolina, and spent a lot of time down there. Long story short, had an opportunity to buy a really rough 280 unit 1970s deal. So I went from buying 40 units, 30 units, 23 units to buying a rough 280 unit property that needed a couple $1 million renovation. Put together a package, pitched it to an investor, and thankfully he saw the opportunity and he backed me on it. We got a loan, and we went on to turn that property around in 24 months, sold it, doubled his money, and then we were kind of off to the races. And fast forward to today, I think we've done about 6,000 apartments on the acquisition, about 5,000 on the acquisition side, and another 1,300 units of development all throughout the Southeast. But long story, a lot of bumps and bruises along the way. Made no money from 2008 to probably 2017. Just trying to survive and do right by our investors, one deal at a time. And we were fortunate enough we caught a good run, and very thankful for where we are today.
What would you place your success from? I mean, you took care of your investors.
Yeah.
I mean, Was that the priority throughout?
That's always been the priority and continues to be today. I think, even when we were raising small, a couple $100,000, we always acted as if it was a couple $1 million that we raised. And then when we started to raise a couple $1 million, we acted as if it was $10 million. And then we raised 10, we acted as if it was 50. So, always kind of took the entrepreneurial spirit of our business, but more of an institutional mindset when it came to our investors and reporting and doing right by them and, over communicating. And I think, for us, we were fortunate, you get a little bit of luck, it doesn't feel lucky in the moment at times, very similar to today. But we didn't get over our skis. We always really tried to stay in our lane, for better or worse. I look back and do I wish I did, 3 times as many deals in 2012 to 2015, 16 that I did. Yeah. But I think that kept us focused, kept us humble, and kept us, building our investors' trust along the way. Many of our investors that were in that first apartment deal are still with us today. I'm very grateful for that.
What lessons from that phase still influence how you operate today, Christopher?
I think it's a big part of how we operate in our underlying core values. As tough as it was for myself, Lisa, and starting a family during that time, and so much uncertainty and unknown, I think that's always kept us very grounded in how we look at the deals that we pursue and ultimately acquire. We go into everything assuming that we're gonna own this deal for 10 years. So is
Mm-hmm.
this a deal we want to own for 10 years? Is this a market we want to be in for 10 years? Is this capitalized appropriately to own it for 10 years? Just having that kind of embedded sense of like, hey, things don't always go great. Like we lived a really tough time for many, many years as we were building this. And I think we try not to forget about that. Howard
Mm-hmm.
Marks, who's a tremendous investor, says it well, and I've said this, very frequently. When times are good, you tend to forget that times can be bad. And when times are bad, you tend to forget that they can be good. So I think having experienced both ends of that, helps keep us going during the tough times. But during the good times, we bought one deal in 3 years, 21,
Mm-hmm.
22, and 23. When guys were, it was really hard to watch groups go by 10, 12, 14, 15 deals, in a given year when the faucet was wide open with capital. We didn't buy, we sold 13 deals during that time. And I think that's really kept us very grounded in our approach to every acquisition that we do.
Nice, nice. Going back to say around 2010, I mean, you made that major shift moving from single family into multifamily, and you had some advice, some skilled advice on that to take that jump. But what was it inside you and your wife? You work together here that helped to prompt that. Many people stay in single family homes, but you made that jump into multifamily. What
I think
triggered
for
that?
me, what I fell in love with when I started to learn it was that it was a business at the end of the day that we were
Hmm.
buying. When you start to get to that scale, each property is a business and the value is derived from the income that you can generate. And you have a lot of control on the outcome. There's very few industries that you get the ability to invest in a business like multifamily and go through every aspect of that business, the physical asset. You can walk every single unit. You can scope drain lines. You can check roofs. You can check HVACs. You can, go through every tenant file. You can go to your competitors in that
Hmm.
business, right? And go walk those properties and understand where the opportunities are, right?
Hmm.
Where can we pick up margin because maybe the staff is really poor at our direct competitor, but they're achieving higher rents than we're achieving over here. Our finish level is inferior to our neighbor, and there's an opportunity for us to renovate and generate revenue. I think the
Hmm.
fact that we can control, listen, there's always going to be macro factors that are out of everyone's control. But I think
Yeah.
what we loved about it is, we have the ability to control a lot of the moving parts on a day, all of the moving parts on a day-to-day basis to
Yeah.
help protect and grow that asset. And market factors are going to be market factors. I just want us to be the best we can be for where the market is at any given time. And I think
Nice.
that's what
Nice.
I fell in love with and continue to love, that we love taking broken assets and fixing them.
I guess there's a saying: taking you know what and turning it into
Yeah,
cream cheese,
yeah,
which
exactly.
which you have which you have done over and over. I mean, you've built your business around value add investing, targeting B and C asset classes with that upside. Um, could you walk us through how you identify a deal, Christopher?
Yeah. So I'd call us, we do a lot of value add, but I'd say really kind of the word that I like to, we're more opportunistic, I would say, than
Okay.
anything, right? So we will look at everything from brand new deals to 1970s deals that are vacant and everything in between.
Okay.
Trying to identify opportunity to create value at the end of the day, to your point, value add, but being more strategic around where's the dislocation on that asset and can we go in and fix what's broken, whether it's operationally, and we're very big on basis.
Okay.
So we are very, very focused. I'd say we're more focused on basis over yield in the short term. because you get one shot at your basis in this business. And if you can get that right, that kind of protects you through challenging times like we're experiencing today, in our market due to the imbalance on the supply side and obviously interest rates where they've moved. But we're really, really focused on basis. So we're trying to sink our teeth into some sort of issue at the asset level or ownership level that can give us an edge relative to competing assets in the market that have sold and or are operating competitors.
Yeah. Such as undermanaged, improperly managed, operational inefficiencies. Yeah. Could you elaborate on some of these?
I think for early on, it was a lot of 1970s, 80s properties that needed major renovation and intensive management to turn them around. So aging assets that we could buy at, a attractive enough basis to put the adequate amount of capital into those deals to turn them into a performing workforce community. And we bought literally during COVID, we bought a vacant 288 unit property in Charlotte, the most blighted property in all of Charlotte. 400 violations, class action lawsuits. Ooh. But we bought it at a price point that allowed us to put $10 million into that property over 18 months and turn it into a clean, safe workforce community. Wow. So that's an example of a very intense physical turnaround. In the same breath, we just bought in Wilmington the end of last year, around October, November, a great, super clean little 117 unit townhome property that was owned by a group for 10 years that was more focused on retail and light industrial, kind of managing with a residential manager, way under rented, hadn't been updated in the 10 years that they'd owned it. And it was in a great location. So, deal was 94% occupied. We bought it with the intention to go in, bring professional management, great service, spruce up amenities, do unit renovations, and do a mark to market as units turned over. So it wasn't like this monster heavy lift, but just capturing the delta due to operational, underperformance from prior ownership. So it's a little bit of everything. We bought a brand new deal from a developer that just had massive delays, and they were at a loan maturity and they were just exhausted. They were 5.5 years into the deal that they built, because they had a 2-year delay on getting a CO and their construction loan, which they rolled into a bridge loan. Now the bridge loan was maturing and they just wanted out at cost. So we were able to buy basically a less than 3-year-old property for their cost.
Nice.
And go in and bring our management. And that deal is not going to produce screaming cash yield today, but it was the cheapest purchase in the entire MSA for that type of vintage in the last 5 years. So we know we're locking in good value, and we're very bullish on the submarket over the next 10 years.
Mm-hmm. These are gems for people just starting out in this arena. Your experience with different facets of value add. I'm calling it value add because that's what people are used to, but operational inefficiencies. Yeah, there's another word for that too. You're bringing value. You're bringing quality back into communities, back into where people live, working people live. And this is what is so short in our country right now. We need housing for the people that keep this country running day by day.
100%.
Yeah.
And so that's really our focus, right? Even on the higher end of the spectrum, whether it's something that we develop or one of the newer assets, like we don't like to play at the tippy top of the market. We have one asset that's a primo A+ institutional property that we built with the intent to own for long term, but the majority of our portfolio is catering to 65 to $120,000 household incomes. And I love taking, we bought a property January of 2024 from a group that was getting out of the business altogether. They had an easy run in 21, 22. Things started to get tough. They realized you got to know how to operate in this business, and they wanted to be done. We bought the property, great neighborhood, great submarket, but it was running like low 90s, upper 80s. The pool had never been in service since the day that they bought the property, which was about 3 years prior to.
Ooh,
We went
yeah.
in 6 months, dug that pool out, put a brand new pool in, had all the amenities up and running, put a fire pit in, cleaned up the grounds, had the property running at 95%, and ultimately sold it about a month ago in 26 months from start to finish. But to see that, it's very gratifying in our business, because you do have a direct impact on people's lives, and how they live every day, and the quality of life for them.
Yeah. Got a question here about your vertical integration now.
Yeah.
So you're vertically integrated with your own management arm, URS Properties.
Yep.
How important is control over the operations in your strategy? And as a follow-up to this, what goes wrong when investors outsource that piece?
Yeah, we've lived on both sides. When we were starting the business, we weren't big enough. We were geographically spread out. At times, we had 2 or 3 different management companies that we were working with, and kind of managing them. Then, as we started to gain scale, we went to a management company and said, "Hey, we'll bring all of our employees from these 2 or 3 different companies with us that work at our sites." We've built a relationship with them, because we've always acted as if they were our employees. The site teams are so critical to long-term success in this business. And then that company allowed us to kind of operate inside their umbrella in a silo, with our portfolio. And then when we started to add development, they said, "Hey, you need to use our development team, our new lease up team." And it became a little combative, because they weren't accustomed to moving at the pace that we wanted to move in. And they ultimately came to us and said, "Hey, listen, we manage 100,000 apartments for institutions, private equity, regional owners, individual owners. Nobody's as hands-on as you guys in our entire portfolio. You're never going to be happy unless you take management on full time. You take it over." So they were nice enough to I said, "Are you firing us?" He's like, "No, I'm offering you something we only offer a handful of our clients. You take over the management of the front end. We'll continue to support you on HR, accounting, payroll behind the scenes, but you own the management side." And that's been a really nice relationship for us over the years, because we view that as our secret sauce. We're just so hands-on on the operations side. From asset management to myself, I'm still on calls. I still jump in and talk strategy, marketing, review websites, review all the KPIs. I look at our portfolio in the morning and at night every single day, in real time. And for us, it's kind of a loss leader. We're not doing the management to make money. We're doing it to exactly what you said, to have full control and be able to move quickly and swiftly when issues do arise, because they arise every day in this business. And I think that's where some folks get hurt in third-party management, if they don't have the infrastructure in place to do appropriate asset management, where they wait for a financial report to come and a property management package on the 20th of the month for the month prior. So now you're looking at something today that's already 45 days, sometimes 60 days lagging, right?
Yeah.
So you're looking at lagging indicators versus on a daily basis, we're trying to identify the leading indicators. What do we need to get ahead of? What's not trending the right way that we can fix over the next 30 days? Not, "Oh, well, shoot, we missed on all this. Why did this happen last month? So now we're putting all our energy on something that already happened a month ago," versus how are we going to correct today? And I think a lot of times people think in this business, you can just buy a deal and hire a management company. It's just, there's more moving parts in multifamily. I'd say office is probably up there, but there's longer tails on the leasing there, but there's a lot more moving parts on TIs and things like that. But it's an operating business. And I think that's what people miss when they just try to buy some properties and go hire a third party. There's plenty of great third party management companies out there. I think it's all about the infrastructure of the sponsor to be able to appropriately asset manage that team.
This is gems again here. So you've grown to nearly $620 million in assets across 15 properties.
Yep.
And about 3,000 units. What were the biggest inflection points in your growth?
That's a great question. I think being a good seller is it just as important as being a good buyer in this business.
Okay.
Meaning knowing that you're not going to be able to time everything perfectly, but Chris Gorman, who's my managing director, says this all the time. He's like, you don't give yourself enough credit for knowing when to sell. And we've sold deals early, but I look at things that if we've completed our business plan and we're ahead of schedule and hitting, year 5 numbers in year 3, I'm a big believer in Sam Zell, so I'm digressing a little bit. I have his books on my desk and it's highlighted like crazy, but one of the things that I've always taken away from him is every day that you continue to own an asset, you're agreeing to purchase it at what the market would pay for that asset today. So would you buy this property today at the price that the market was willing to pay for it? And if the answer is no, I wouldn't pay that number, you should probably think about selling it. And I think that's been a big inflection for us, was that 2019 to 2023 run where we were aggressively selling into the market. Going into COVID, I thought the market was getting frothy to begin with. So we started selling in 2019. COVID came. We took a little bit of a beat. We bought 3 properties. Then we all know what happened post-COVID. And then once that started happening and we started seeing the deals that were being acquired, it was just sell, sell, sell. We brought the portfolio down to, I think, 4 assets. And that to me was probably the turning point in now setting us up really well for our next leg of growth for the next 10 years. And, we started actively buying again in the beginning of 24, and we've continued to buy through these periods of tremendous uncertainty. We've bought 10 assets now, 10 properties since January of 24, when that's not an easy task for private kind of groups to do in this environment. And I'm very proud of that.
Very good. Yeah. So what does separate operators who scale from those who stall based on your experience?
Yeah.
What is it?
I think it's really, it all comes, I think right now we're seeing it all comes down to operations. Make no mistake, we are feeling the pressures in our portfolio just like other groups. I think we've been very disciplined about leverage, and that stems to back in the early days of 2008, 9, 10, 11, seeing what happened to folks who put too much leverage on their deals. I think that's always stuck with us. Our average LTC in our portfolio is probably about 61%. So we tend to bring a lot of cash to our deals and sacrifice returns on paper in exchange for that, what we believe will turn into longevity to get us through tough periods. Because time does heal all wounds in this business. We've seen it. You can look back 50 years in our space. You have recessions, you have pullbacks, but they usually revert back to prior levels, whether it's over 5 years, 10 years, 12 years. You need that staying power. And too much leverage can kill a good piece of real estate very quickly. And I think that's probably what we're seeing today, are the groups that bought in 21, 22, high leverage, floating rate debt, very aggressive business plans. There is nowhere for them to go. There's nowhere to hide at this point. The market hasn't moved much in the form of rents downward in most cases, and rates have stayed, meaningfully higher than they were in 21, 22. So for me, the separator is, and we tell our investors this all the time, it's, hey, we'd rather put on paper and go out with a 14 to 15 or 14 to 16 target IRR. Then I can move my leverage up to 75% and I could put a pref slug on there for another 10%. And I'll show you an IRR of 18 to 22 if you want, or I can assume 5% rent growth and a 4.5 cap exit and show you numbers where we're not leaving ourselves any margin for the upside. We're only leaving ourselves margin for the downside. So, for us, we try to go out in a place where it's, how do we protect the downside first and secure the capital preservation is number one. And then number two, what's the plan to capture as much upside as we can throughout our hold period? And if we get some market tailwind, that's the bonus.
not relying on the market for sure.
Yeah.
Well, you've raised over $280 million from 300 plus investors. That's very much a relationship driven business. And how did you build that level of trust?
It's
That's a lot of investors. Yeah.
It is, and we're very, very fortunate on that side. It's been 100% private capital, no institutional money, knock on wood, to date with us. But we've done it because of what I said earlier. On that first 40-unit deal for $500,000, we acted as if it was a $5 million deal. And that meant I did quarterly webinars every single quarter. We've carried that forward. We have one underlying discipline when it comes to investor relations. We never, ever want one of our investors waking up wondering what's going on with their investment with URS. And I think that's what's built the trust more than anything. Because don't get me wrong, we have some 6 and 8 IRRs in our track record. I usually talk about those more than the 30s, 50s, and 100s, because I think that's what's allowed us to continue to grow when others couldn't, because I got on those calls for those deals that didn't go how we thought they were going to go every single quarter, and had to talk to our investors on calls just like this and let them know exactly what was going on. We have to change managers. We have, there was a market issue, or, there was a fire, whatever it is, but we are committed to this deal and we are going to grind it out regardless of the fact that we're not going to make $1 on this deal. We're going to protect your capital and do everything that we possibly can to preserve that capital. And I think that's what's built the trust more so than, the average 30 IRR and whatever 2x plus multiple. And that's given them peace of mind that, hey, we might not always get everything right or perfect, time something perfect, but we are going to be committed to protecting their capital first and foremost. Right. And that's what's gotten us to where we are today, thankfully.
So could you repeat again your averages that I'm sure the investors are looking at that.
Yep.
But also they're appreciating your approach, to preserving capital first. You're approximating the 30 IRR?
Yeah, so on the 23 deals that we've sold to date, I think our average is about close to 31 with like a little over a 2x net multiple.
Nice. Wow. There we go. Okay. What about today? I mean, what are investors actually caring about today? Capital for sure, but what has changed, or has anything changed?
Yeah, I mean, a lot's changed. I think it's been a challenge for most to raise capital. We're fortunate that we've been able to acquire what we've acquired during this time. You're in a higher interest rate environment. It's tough to make sense of a lot of deals, going in. You have to find something that you really can sink your teeth into. And from our investors' perspective, they get it. They understand. We're very transparent that, hey, our thesis is, we know when we were buying in 24, our messaging was, hey, 24 is going to be tough, 25 is going to be tough, 26 is going to be tough. The numbers don't lie. We're coming off of 50-year highs in supply that our markets need to absorb. But if we can be patient, we have the opportunity to take advantage of this dislocation and acquire assets at a very attractive basis and position ourselves very well as this supply gets absorbed and new starts diminish leading into 27, 28, 29. We think we're going to be positioned very, very well within our markets. And at that point, we're going to see a flood of liquidity come back into the market. So our investors are looking at, basis, long-term growth, tax efficient cash flow. Our strategy is to get to a 6 to 8% cash yield inside of 36 months. And then at that point, we have a free call option on the market as to when to sell. If the market's not there, we're going to keep generating very tax efficient cash flow and building appreciation and equity over time. The market starts to run, we're going to take a look and start to harvest gains on we always comb the barrel. We look at assets and say, okay, is this in line? Do we want to own this for the next 10 years? If the answer is kind of like, hey, we've done well in the business plan, we're there, we've hit our numbers, we've outperformed, and we don't think that there's much more of an up leg, we're gonna harvest the gains. And then there's others that we're gonna say, hey, we love this market, we know it's got a 10-year runway, we want to own this for the next 10 years.
Okay. As far as the financial end of things, you've successfully refinanced over $90 million in loans in a high rate environment here.
Yeah.
Not easy
Yeah.
right now. What's your strategy for that, as far as operating in today's market?
Yeah. So on the debt side of things, there is
Hmm.
a plethora of liquidity in the capital markets for debt. Equity, not so much, but debt, yes. We typically tend to, if the properties that we're looking at or deals that we're looking at can allow for it, agency is the most efficient. We do a lot of Fannie and Freddie financing,
Yeah.
either 5 or 7 year fixed rate financing. However, the banks have gotten a lot more active over the last 12 months. The last two deals we've done have been bank loans, regional banks. Because some of our deals are transitional, so they can't necessarily fit the agency box, or we don't want to slap on fixed rate financing that's very expensive to get out of if we have a business plan to create value over the first 36 months. So we've looked
Hmm.
at, we've worked with two different banks over the last 6 months, actually three, and they've been
Hmm.
very, very aggressive on their spreads. And they're great partners.
Yeah.
They get it. They tend to be a lot more localized, like relationship driven, asset driven. They can
Hmm.
understand and come out, and you can talk through the business plan a little bit easier than you can with the big institutional, debt funds
Hmm.
and or Fannie and Freddie. But our
Hmm.
goal is to when we get to that point where we know we're keeping an asset, it's agency financing is the most efficient in the market for fixed rate debt.
Hmm. Hmm.
But it's been tough for sure because rates have been, obviously things were moving in the right direction, then the Iran side happened and
Yeah.
rates started to rip upwards.
Yeah.
So it's
Hmm.
definitely thrown a little bit of a wrench in the market, I'd say, especially on acquisitions.
Hmm. I thought we could take some time here, Christopher, to highlight one of your deals, Richmond Hill. And
Oh yeah,
yeah, yeah. So you achieved 29% IRR and 2.69%
yeah,
equity multiple on that. I get that
yeah,
right?
yeah.
Latitude at Richmond Hill. Could you walk us through that deal, please?
Love that deal.
Yep.
That was one that was a little bit tricky in terms of do we want to sell this one or not.
Hmm.
So we bought that. I want to say it was probably right around, if I remember correctly, 2019-ish. Um, and we bought it from a local developer. So great example, a local home builder family in the Savannah market, great people.
Hmm.
This was the second property we'd actually bought from them. And their strategy is they kind of are single family builders by nature. And then once a year, they'll build a multi-deal, whether
Hmm.
land that they've been sitting on for years, and they self-manage. So they self-build and self-manage. So they're able to build much more efficiently than you or I could going into a market in terms of their costs. And
Hmm.
then they also self-manage. So they're not very sophisticated on the management side. It's very,
Yeah.
very mom and pop.
Yeah.
And this was a new build kind of in a tertiary submarket of Savannah, like one of only three deals, but great schools. The basis was fantastic, and we bought that deal at about 60% occupancy from them. So we
Hmm.
took on the lease up risk to secure a very attractive going in basis. They did well on it. It was a win-win. It was our second deal with them. So we did a bridge loan for that because it was not stabilized. We brought our management team in and we were able
Hmm.
to complete the lease up, stabilize the asset. We operated it for about 4 years. And it was kind of like end of 22. So the world was turning when we were contemplating selling. And we knew that this was probably going to be our last exit for a couple of years. And it had been a 1031 exchange from another property, went into that one. And we had doubled the equity on the prior sale, and then this one was another 2.6 or 2.7. And it was just one of those where, going back to Sam Zell, would we buy this deal for what the market was willing to pay for it today? And during that time when rates were starting to run and the world was getting a little squeamish, we said,
Yeah.
hey, why don't we sell this and see if we can reset our basis on the down leg of the 1030, up leg of the 1031 into another property and take advantage of kind of the dislocation. So we sold that, I think, for about 220-ish a unit and did really well. And we 1031 into Views at River Bend, which is in Beaufort. It was a 2000 vintage property owned by the same group for about 15 years. All original, great property, beautiful views, 200 and I want to say 40 plus units. And we were able to acquire that for 175,000 a unit and go in and renovate the amenities, the pool, etc., and we assumed the debt on that, so we were able to get below market financing at the time at low leverage, and now we're going to own that asset for the next 6-7 years until the debt matures there.
That's quite a story here that people need to hear on intelligently purchasing a property at the right time and gaining from all the quality you put into it, and then exiting when you need to exit, which is when most people are thinking the other way. And I got to mention here, you have discussed that your North Star philosophy is so important here. Your philosophy to provide high quality housing at relevant price points. Why is that central to your strategy?
I think it's a lot of how we built our business, right? We built our business around some really rough deals. And to see the impact on our efforts was extremely rewarding. I mean, that first 280 unit property we bought had 25 down units, drug problems, prostitution, gang issues. We brought in 4 cops within 30 days, gave them free apartments. We invested $2 million into the property, got all the down units back online, cleaned out all the riffraff, and delivered it to the next owner as a really functioning, great workforce community. And I tell this to our teams all the time on our calls, right? There's several things that cost nothing. Cleanliness costs nothing. Good service costs nothing. Curb appeal costs nothing. Those are things that I want our properties to be the best at their price point in any one of our markets. So if we're at a $1,200 a month apartment community, I want it to be the best $1,200 a month apartment community. If we're at $1,800, et cetera, $2,000, et cetera. And we have some that are, rents are $2,500, $3,000, like A+ institutional asset. They demand a certain level of service that has to far exceed what we would give at the 1,200 community. But that $1,200 renter deserves safety, cleanliness, and great service just like anybody else. Do they need the virtual golf room? Do they need the putting green? Do they need the fire pits and mini virtual markets? No, but they need a good, clean, safe place to live, just like anybody else. And that to me, is one of the most. We've worked with a lot of local on that Charlotte property. We worked with the head of housing for Charlotte, the local police force. It was a very hands-on effort to turn around the most blighted community in Charlotte for the most part and make it a thriving, place for people that just need somewhere clean and safe to live.
Yeah. Big impact on the community there. And that's you delivered on that, and a lesson for everybody going in on this. I mean, that's where we all need to be to create the kind of quality housing that all of us in this country deserve. Christopher, you've gone from operator to leader of a full, huge organization. That takes a lot of leadership skills. What did you have to change in yourself to learn how to scale and lead like you have shown?
I am an obsessive kind of learner and constantly looking at ways to improve personally. And it's definitely an adjustment when you're running a 3 or 4 person investment shop with third party management to now overnight you have, overnight meaning the last kind of 3 to 4 years, 60 employees across, multiple states and multiple geographies.
It's 2 to 3 units, that sort of thing. What advice would you give to them?
You cut out on the first part of the question.
Oh, what advice would you give to someone who is wanting to make that jump from deals in the 1 to 4 unit range to larger level investing. What
Sure.
would be your advice?
So I think it's, if you could do it in a range, if you're trying to do it on, going from 2 to 4 units to 20 to 40 units, give or take, not necessarily straight to 100 plus.
Mm-hmm.
I think management is so critical at that level. If you can find a market within, a 2 to 3 hour drive radius, and hone in on that, because you're going to need to be a little more present, because your quality of management is going to drop significantly when you're playing in that under 100 unit space.
Got it.
I think that's probably one of the best pieces of advice. What I tell we get a lot of investors that are extremely successful. I just had a call yesterday. Very, very successful businessman. He's on the precipice of being able to step back from his business, as a couple of buddies, and everybody wants to own real estate. He came to me, the 3 of us want to get together. Maybe we'll go to North Carolina, Tennessee. They're in New Jersey, and we'll go buy, a $5-6 million property. And I said to him, I've seen the story play out time and time again. I think everybody wants to own real estate so you can go to the country club and say, oh, I own this building, I own that building, it's cool. But if you have the opportunity to invest alongside a very established group, this is not a commercial for us, it could be anybody that's successful in this space, you might be better off making that investment into an existing operator with an existing operator and platform versus going out on your own and trying to do this, because you're able to get tremendous efficiency on your personal investment. Meaning you're stepping into getting operating leverage from a firm that manages 3,000 plus apartments or 5,000 apartments. You're getting the same benefits of depreciation or pass through. You're getting the same cash flow. You're getting just as good, if not better, returns, because it's a more sophisticated operator you're working with versus you trying to do it on your own. Setting out to build a business in this space is different than setting out to go buy a 50 unit property on your own.
Yeah.
And I always tell that person who's trying to go buy that 50 unit on their own, just sit down and think about the amount of time, energy, and effort it's going to take to actually run that successfully. Or you can invest in a group like ours or many of the other very, very good groups that are out there and get practically the same benefits that you would get by trying to go do this on your own.
Got it. All right. Hey, using your crystal ball here, and after being on this podcast with you, the depth of your experience and how you built your business doesn't seem much like a crystal ball. But what do you see coming ahead over the next few years, and how are you positioning URS Capital Partners for what you see coming down the road?
Yeah, we are very bullish on that. Supply is turning the corner. I think in our space, we're focused primarily in the Southeast, so we saw a massive amount of supply. I'm very confident that we likely won't see 50-year highs in supply again in my career, maybe in the next generation's career. And I have high conviction we're likely not going to see 0% interest rates in the foreseeable future.
Yeah.
So
what an anomaly. Yeah.
Yeah. I do think over the next few years, we're positioned very well. Demand has been very durable and resilient in our space. And I think when we get back to that equilibrium, we're going to see a massive amount of liquidity come back into multifamily over the next 3 to 5 years. And what we're trying to do is to be ahead of that. Rather than waiting for all the indicators to be positive, we're trying to buy good assets in good locations and position ourselves very well to take advantage of when that normalization comes back to the market. We don't need to see 5 to 10% rent growth. I don't think we're going to see anything like post-COVID rents in the foreseeable future. I'm not naive. But I think that just a concession burn-off and a normalization back to 2 to 3% rent growth will create significant value for operators and investors who acquired in 24, 25, 26 are going to benefit from that from 28 to 30.
Nice. Well, Christopher Urso, thank you so much for being on this podcast. We're going to wrap it up here now, even though I feel like we've only touched the surface of the kind of experience and depth that you can bring to our listeners here and anyone interested in pursuing real estate at the kind of scale that you've achieved here. Where can people find you online, sir?
Yeah, so I'm very active on LinkedIn. So Chris Urso on LinkedIn, and then urscapitalpartners.com. Please reach out if you want to join our mailing list. You can sign up right there, and we put out really good content. Our YouTube channel at URS Capital Partners is fantastic. We do very comprehensive quarterly reports across our entire portfolio for the public to view. I don't think anybody else in the private side does that for their whole portfolio.
Excellent. Christopher, thank you so much. This has been great being with you, sharing your experience online here with our podcast. So thank you so much. And that's a wrap. Appreciate your time, sir.
No, I really appreciate it, Bill. Keep doing great things.